great.
say one more thing, Eddie. I think what you're saying is totally true, and I think it's something we've seen in the last couple of years that companies have been wanting to try and get the offsetting insetting action closer to their business. And so I see more industrial companies looking at industrial credits, and ad and FMCG companies perhaps looking at nature, etc. So yes to that, totally understand. And I think as the market recovers, there'll be greater variety rather than less of different credit types. The other thing to watch is obviously the voluntary market has been learning some pretty expensive lessons in terms of what works and what doesn't with different methodologies and how to make sure that you produce high integrity credits.
Hey everyone, welcome back to This Week in Carbon. I'm your host, Eddie Smith, alongside Renee Velasquez. And today we're thrilled to have on Donna Lee and Duncan van Bergen from Calyx Global. Thank you two for joining us. We're really looking forward to today's discussion, and we've got a number of topics to cover. So I think just to start off, I would love to, ask about Calyx's beginnings, and maybe if you could, introduce yourself and talk about how Calyx started and the problem that you set out to solve, and then maybe also talk about how the ratings approach has evolved over time. That would be great.
Duncan, do you want to start? Why don't you start?
Okay, I'm happy to. But hey, first, Renee, Eddie, thanks for having us.
Pleasure
Congratulations
having you
on
guys.
no, congratulations on what you guys are doing with the Week in Carbon. As I the other day, I was running in the evening and I came across somebody that I knew, and we both stopped. And she pulled her earpods out of her ear and she says, "Oh, I'm listening to the latest The Week in Carbon episode." I'm like, okay, now you know that you've really made it up to a certain level. So congratulations to both of you.
Thanks.
Thanks
Thanks for that anonymous runner for listening.
yes, indeed. So yeah, look, honestly, I believe Donna and I both came from a place where, with our own very different but relevant backgrounds, we had a firsthand understanding of how difficult it is for a buyer to really get a good grasp of whether what they're buying and what carbon credit they're buying, whether that really stands up quality-wise, whether it stands up to scrutiny quality-wise. And I think and I hope I can speak for you on this, Donna, we both came with a fairly positive mindset in terms of saying, well, people, if they're going to use carbon credits as part of climate action strategies or sustainability plans, they actually want real impact. Yeah, it's not just for fun and giggles. But it's incredibly hard to get the information you need because it's a complicated matter. Yeah. So we felt that information was too hard to come by. It was too complicated, too expensive to really get an objective, independent insight into whether carbon credits companies were buying really stood up to the claim. So it is something we wanted to do something about. Now, obviously, there is also the flip side of wanting to make sure you have impact is wanting to make sure that you're not exposed to risk, reputation, financial, legal. But that's really what we both thought. Hey, as more money is coming into the market, there's this opportunity of scaling impact, and the participants in the market want to be part of that positive journey, but they just don't have the tools at their disposal. And Calyx was conceived as a platform where we would help our clients achieve that in a more practical way than was possible before.
Yeah, maybe I can just add a little bit of my own personal perspective. I will say Duncan and I started talking about creating Calyx Global or carbon credit ratings literally at the time that I was trying to retire, which was tough. It was actually a really tough decision for me because I was ready to land that plane. I had been working on climate for about 20 plus years. I had been watching the markets, And when we were talking about this, for me, at least personally, I knew that the markets were not achieving the impact that it could have. Having worked in particular on red, I worked a lot on red. I just knew that, that a ton wasn't a ton for many of those credits, but also for other types of credits, renewable energy, some other types, and that suddenly we saw this money flowing into the markets in that 2020, 2021 time period. And wow, like what more could this money, what more impact could this finance have? And could we do something about that? Could we drive more of that to higher impact for people on the planet? And I think that's our mission, and kind of stuck to it since then.
Awesome. Yeah, thank you guys for sharing. And, before we dive into the first segment, I mean, I also want to ask, what your initial thoughts were on the ratings as a whole, right, for the carbon market, and how that has, evolved within the market over time to, enhance that integrity, right? Because I think, Calyx has a huge role within the ratings in the market. So I'd love to hear your thoughts on that and the kind of evolution of the approach, right? And what it sets out to achieve.
Maybe I'll just take a first stab, and then Duncan, you can chat. Because one thing you asked, Ed, which I thought was interesting, was in the first question that I didn't address, was how have your ratings changed?
Yeah.
And I don't think ours have, to be honest. I think we've been pretty much, our ratings have been, I think, pretty stable in some ways, and our approach has been pretty stable. And it always comes back, at least. So we have 3 different types of assessments on carbon credits. We try to take a holistic look. So we have our greenhouse gas integrity, our sustainable development impact. And I will say the one thing that has changed is a couple years ago, we started looking at environmental and social risk, just realizing that would help, really give the full picture. On greenhouse gas integrity, our ratings have always been, what does the atmosphere see? Is what is being claimed by the credit what the atmosphere sees? And for that reason, our ratings really haven't changed. I will say we took a long time. I think we brought together carbon market experts, folks who have been working in the markets, sort of the dinosaurs, the cognoscenti, like people who have just been around a long time, right, to help build our framework. We set up a governance structure. We spent over a year working to get a framework that we thought could provide consistent, comparable ratings across many different project types. So bringing also people from energy, waste, nature, all different sectors together. I think we went through over 10 iterations during that year plus long period to land on a framework. And for that reason, we really haven't changed the way we rate. But I think the role of ratings have evolved, and maybe, Duncan, I'll hand it over to you.
Yeah, no, you mentioned the 2 things about us. We spent a long time, and our environmental and social risk assessments were a new feature. I believe that compared to when we started, I remember having conversations in the early days with our first prospects and then clients, where quite regularly I'd get hey, but hang on, don't we already have carbon crediting programs, standards in this market? Why'd you need ratings? Isn't this just adding a layer on top of things? I feel that that page we've turned. These days, I hear from project developers, also from organizations like the VCMI and others, that, hey, ratings are just an important piece of the ecosystem. So I think that has changed significantly. We can talk a little bit about what we're seeing come through in a correlation between ratings and pricing. Correlation not the same as causation. I buy that, but at least there's some interesting data starting to emerge on that front. Ratings are now also for projects coming to market a key piece in, hey, how do I find market? Yeah, it becomes a piece of the story of a project, not just who's the developer and what's the project type and which methodology they use, but also what's the rating of the project. And so in that sense, I think ratings not only have a more important role today, but also a very heavy responsibility, to make sure that we do our work properly, because we play a role in price discovery. We play a role in the ability of go to market. And I think that's a real responsibility. And looking down the horizon, I could see things emerging like regulation of ratings, etc. It's still down the horizon, but I think that is one of those things of recognition. It comes with that recognition that ratings play a more important role. Well, then we better make sure that they work properly. And I think that's a real responsibility that the whole team at Calyx is quite conscious of, and don't take lightly.
Yeah, 100%.
I like that.
You want to say something?
Yeah, I do. And so Duncan and Donna, both thank you again for joining. I know we've been trying to get you guys on here for a while, and I love these insights. I just wanted to kind of just double click on that point effectively, right? And we chatted about it just before we started recording, but essentially what you're saying is that there was a time before ratings and now there's a time after ratings. And essentially the paradigm shift is one where for too long, buyers in our market have relied on heuristics, essentially rules of thumbs or legacy labels, right? And focus on project types, which one's better, which one's not. And this is kind of, a very, very kind of non-scientific view around how to approach it. And now we're entering this new era driven in large part by the data provided by ratings, where decisions are driven not by those assumptions, but by that data. And you're at that forefront really of that transition. And so I see it from two sides, right? Because like any market, there's two sides of the coin. There's the buy side and the sell side. From the buy side is essentially applying structured and transparent empirical, like data points and then hence your ratings to help them to make better decisions around what to buy. So separating the signal from the noise. On the sell side, I'm interested to see whether there's been any reception of the ratings to improve project design, because ultimately we're driven in large part in this market through a directional kind of bias, let's call it, towards higher quality, higher integrity. Right. So I feel like there's already a number of legacy projects that have been effectively stranded. And I'm wondering whether the next generation of projects are actually just driving towards this higher integrity and higher quality framework, again, driven in large part by your ratings. How do you guys see it from both buy and sell side? Who wants to take that one?
I'm happy to start. Donna, you should definitely jump in. So again, in line with how we do things at Calyx, let's be data-based, let's be research-based. There are some data points. So we have this monthly index that comes out, or a series of indices that come out, one of which is the average quality, both of issuances as well as retirements. And so what we have seen is that the average quality of issuances has been trending up, I think, for the last five quarters or so. And we've started the data tracking from late 2021. And you see that, especially over the last 4 or 5 quarters, moving up gradually. Moving up from a base that is too low, but now for the first time, I believe the last measure we were above 5 out of 10. It's a scale of 0 to 10, and so that's a good thing. Now I think we need to stay humble. This isn't the result of ratings. Yeah, I think there's clearly a shift in demand. Yeah, users are asking for more quality or asking for more evidence of quality, and that is driving developers into that direction. Investors have become much more picky with where they're willing to invest, pre-invest, put money to work. And I hope we're seeing the fruits of that labor. What's interesting to see is that average retirement quality isn't going up quite as fast, which is probably due to there still being a lot of legacy tons in the market that are somehow being disposed of. So that's
Well, they're trading at steep discounts, and so it's just that, again, now it's a mindset, right? Like it's a value proposition.
Yeah, no, totally agree. But in terms of what that means for the overall market, I think getting up that average quality level will be important as a sign of trustability of the market. Yeah. When these indices comfortably start being in the top half of the rating scale, then I hope that that will be a signal for more people who are on the sidelines, who've retreated to the sideline or have never been in the market, to say, okay, well, this market is different than the market of the last decade. So that's what I'm hopeful for.
Mm-hmm.
Maybe I'll just pull on one thread that you put out there, Renee, which is sort of differences of opinions between the buy and the sell side on the role of ratings in this kind of transition process. I will say, in general, so we work with buyers, right? Buyers and investors. So we have intentionally decided to stay on the buy side. We work with a lot of buyers. I think they like our ratings. They really appreciate us providing them a view, a comparative view, but also just a view on quality. It helps them to avoid reputational risk. Most of them care deeply about their brand. So in that regards, generally pretty happy with the role of ratings, right? It helps them to distinguish different qualities in what they're purchasing. On the sell side, I would say, it's mixed views on the role of ratings. And I'm sympathetic to that because in some ways, maybe ratings create a little bit of a lack of predictability to some extent. I think a lot of project developers just tell me the set of rules you want me to follow. Let me follow those rules and then sell into the market. Right. And I'm sympathetic to that. I think the problem though is what happened, having been sort of a multi-decadal carbon market watcher, is what happens is you get sort of a race to this minimum bar rather than a race to the top. And I think what ratings can do, and in some ways the ICV SIM's the same, right? They're creating a minimum bar. Standards create a minimum bar. Everyone's creating like a minimum threshold. Ratings can create a race to the top. And so you do have some projects that do more, whether it's being more conservative on their claim, you know, adding co-benefits or the sustainable development impact to the certification process. So there are some developers who like ratings because they are doing more. They do feel like they're making a more solid claim and they want to be able to go out and sell that at a premium. So it's a mix, I would say.
Yeah, I think that's really valuable insight. But to that last point, it's to sell them at a premium. So can we double down on that? Because I know that you guys published a report with Clear Blue Markets recently, and you've got these indices that are coming out. What insights can we glean in terms of that differential? Basically, the basis trade to the upside for a higher integrity project, right? Because like if it's a race to the top, there's got to be a commensurate premium being paid by the buyers that have a preferential view on these types of credits, right? It's going to be a crowded space essentially, because I would imagine that there's not a lot of really, really high rating projects.
Maybe I'll start with this one, Duncan, and then please jump in. But I think what's super interesting if you look at our indices, because we went back in time also and looked at prices in January 2022, and you can see them all the way up to the present. And what's fascinating to me is back in early 2022, the lowest quality got the highest price, and the highest quality got the lowest price. So it was almost like opposite of price discovery. Yeah, and I think the reason why is because
give some examples, Donna.
Yeah, I mean,
without
it
naming
was
projects, but maybe project types or certain attributes that were essentially discounted or dislocated in the market. That's an interesting perspective.
or what was given the premium was storytelling, right? Storytelling and photogenic projects that met this minimum bar, right? That was certified by VCS or certified by Gold Standard or CDM. Like a lot of people, I remember 6 years ago, like a lot of buyers just saying to me, well, as long as it's VCS, like that was our criteria. Our criteria was certified by, let's say, ICROA standards, right? So all the big standards, ACR, CAR, Gold, VCS. Like as long as it's one of those, we feel pretty confident that it's fine. And then they would look for, I think it was storytelling and charisma. So you had a lot of red projects, nature-based projects, selling at very high prices. Even I would say solar and wind make very nice photos as well. So, maybe they had suffered a little bit from some of the CDM days and some of those controversies, but what was not selling well was some of those project types that got the first ICVCM eligibility, right? These were ones that we had really doubled down on and looking at because we knew where they were going to be higher quality, but completely uncharismatic.
So ozone depleting substances, methane leaking.
Yeah, an
leaking.
ODS destruction facility is not a nice photo. A
No, it's not.
manure lagoon, not a nice photo. A landfill, all of these, even a household biodigester, right? Like, I don't know if you've seen
Yeah.
these.
I have
mean,
seen those. Yeah.
Yeah, they don't make nice photos, but some of them are really fantastic, right? And so
But
what
they're
we saw,
unimpeachable from an avoidance perspective, right? Like the science is very, very clear and the permanence is very clear. Do you want to talk about those?
yeah, I mean, there's no non-permanence risk, generally easy to measure, right? If you're measuring destruction of ODS, it's just a canister. You put it on a scale, then you go destroy the substance, you put the canister back on the scale, and it's the difference, right? It's super easy. That's not to say I don't think we should protect nature. It's only to say, like, it's harder. What makes it beautiful is that it's hard to measure, right? That it's not, um, you know, it's aesthetically beautiful because it's not uniform.
But it's a complex living system.
But okay, so getting back to the story, sometime in when was it, Duncan? 2024, like mid last year, is when we saw it. It was when we saw it flip. And that was the first time we saw higher quality, higher prices. And that's really nice to see, like this price discovery. And since that time, the spread has only gotten larger and larger, and now it's something like over 60% higher for higher quality.
Yeah, yeah. And
Interesting.
touching on that data point, I saw that the tier one credits are commanding a 65% premium over the tier three credits. And this was by the second half of 2025, especially for ARR projects and landfill gas projects. But interestingly, nature-based solutions are still enjoying strong demand and price premiums, but the gap between the tier one and the tier three are widening, like you said, particularly with Red Plus credits. So, I mean, what do you think of the situation that happened with Red Plus? And do you see I mean, kind of price levels coming back to where they were, or just kind of the mindset towards Red Plus projects in general? Like, what was your thoughts on that?
Yeah, I'm smiling, and Donna, you should jump in to bail me out. But I'm smiling because I have a background in commodities, and that taught me that predicting prices is about the worst thing you can do. Or you just have to be really bold about it and say, this is what's going to happen, and then who cares? Like in a year's time.
And have ice in your veins.
Yeah, exactly. So look, we're now in the price predicting business. I'll echo what Donna said. Conserving and regrowing nature is absolutely crucial. As we use carbon markets for it, we just got to make sure that the instruments we produce can be traded between parties in full confidence that the claim being made is a good claim. And our job is not to chase the perfect, because sometimes people have said, hey, but ratings, you guys are making the perfect the enemy of the good. Our job is just to make sure that the claim generally holds water. Yeah. The amounts of overcrediting that are still okay to still have a double or a single A rating are already quite significant. So I think the job is not it's not a but an and. Yeah. Yes, I'll do a big shout out to Team Ugly Ducklings, because which is kind of the term we gave to some of these underloved uncharismatic credits and go ugly ducklings, and some of the community projects, nature-based projects, super important. And it's really encouraging to see evolution in the methodologies. VM48 in the case of RED, lots of developments also in all the AR and IFM methodologies, in the household project methodologies. That's exactly what we need, so that we can trade the instrument, the asset, with the same kind of confidence, because this is really a confidence-based asset class. Yeah, Donna published this super interesting blog on credence goods a couple of months ago. Big plug for that. If you haven't read it, go read it.
We'll put it in the show notes.
Yeah, no, please do. But this is really a carbon credit is an asset that's being traded based on trust that it actually does what it claims to do. And therefore, if we can strengthen the bases for that, that's what it's going to take. So not but yes, ugly ducklings and nature, in a way that we can trust the underlying assets.
Can I just, not to plug my own blog, but maybe just connect the credence good to RED, because I think there's a really important connection here, which is, in some ways, a lot of people like to think of carbon markets and then overlay financial markets and like, oh, let's just do the same thing as financial markets. But in this blog, I kind of explain why I think carbon credits are not like financial products. And one important element, which is interesting, I think, about carbon credits is, at the end of the day, if you buy a bond, it's rated X or Y or whatever, you kind of know at the end of the day if it was a good rating, because you either get the coupon payment or you don't, right? It defaults or it doesn't. For carbon credits, only the atmosphere will know in some instances, because, and this RED is a great example. Like, somebody sets a baseline, who knows? It's a counterfactual baseline. All baselines are counterfactuals. And so the chickens never come home to roost in the same way. And because of that, I think we shouldn't overlay the exact financial markets metaphor to the same. Like, we should think about where they are different, and where they are different, build structures and institutions around those to build a strong market. And so, okay, getting back to RED, like, will it live another day? I think it can, in part because the number one issue with RED was setting the baseline. What Vera has done is taken that out of the hands of the project developers and put it into an independent third party. And at the end of the day, I think that is the best approach to build confidence. So those are the types of, I think, market maturities that are occurring that can really help. And I think there will be a shakeout a little bit in RED, like those who set a super high baseline but actually weren't reducing deforestation, like, probably won't survive. But those who were actually doing some really good work on the ground, really helping to stop deforestation, I think that they will live another day. I hope so, at least.
Yeah. I mean, we had a great conversation with Mike Gorczynski at Wildlife Works 2 weeks ago, and he was talking about this and the situation with the baselines. He's saying, he's saying how to this day I can't really answer that question of what my baseline is for the project. I can't determine the economics of my project. So Renee, did you have any thoughts on,
No, I think that there's a place for RED plus nature-based avoidance projects in most corporates' portfolios. To Donna's earlier point around the charisma and the impact that's measured beyond just the 1 ton of carbon, right? The social, the community, and the biodiversity impacts are quantifiable. And what I know from experience is that when clients actually go and do the project site visits, they're forever changed because of those links to the communities and into biodiversity. And so they have a place, but they are not perfect, right? To Donna's points, right? And but I think in portfolio construction you can kind of create a balanced approach. And to you, I like this credence goods kind of approach, right? Because it's kind of difficult to evaluate after the consumption piece. And ultimately, the point of it all is to try to create a balance, right, with regards to the balance sheet. right? So you've got emissions on one side as a liability, and effectively you've got the carbon credits on the other side as a credit, essentially. I'm just curious, your thoughts around a balanced portfolio type of approach. Does that mitigate concerns around durability, for one? So we term that historically as permanence, but let's call it durability because I think it's more applicable, or the additionality. And then see the question about baselines. Let's put that to the side because we beat that like a dead horse.
Can I make a quick plug for something, Renee, that you said just now,
Yeah,
which
sure.
I think is super important. And I'm glad you said it. You said, look, the other impacts, the whatever you want to call them, co-benefits, SDG impact, can actually be assessed with rigor. And I think it's actually super important. I was at a conference last June, and somebody in the audience asked a question, and I was on a panel and said, hey, look, we all know that claims of co-benefits or SDG impact are actually just a can of paint that the developer uses and puts on. We want to contribute to rigor and evidence-based assessment of those claims, because you're right. Some of these projects are life-changing in the places where they operate, either on the environment or for the communities. And so that's why we spent a long time, just like for the greenhouse gas ratings, we spent a long time trying to figure out how can we do evidence-based assessment of claims of impact. Thanks for plugging that. But back to your portfolio question.
Yeah, I'd love to mention that and then say something also about the SDGs. And here I am speaking as Donna Lee, not as Calyx Global. As a ratings agency, we don't take a view, but I've been working on climate change a really long time. And I really like your portfolio approach, Renee. I'm kind of a fan of the Oxford Principles that kind of looks at what do we need today? Like, we need to turn the tap off. And so, avoidance credits today do a lot of good for the atmosphere. But they also say we've got to absolutely protect and restore nature. So make that part of your portfolio. And then we have to invest in future ways to suck carbon out of the atmosphere, because we're not going to get there. So they kind of give a balance of what we need today. Let's buy in those proportions. And then over time that will change. Well, I hope it will change, right? Like, hopefully we get to the place where emissions have gone down and we really need to focus on removals, for example, right? So I kind of like that approach of thinking of a portfolio in terms of a time horizon. And so I'm a big fan of that. And then maybe to Duncan's point on the sustainable development impact, I think one of the really wonderful things about the voluntary carbon market that probably will not exist in most large developed country compliance markets. And I say large because this doesn't count for like Singapore, where you and Duncan are. Like the small city states, this is not part of, right? But for large developed countries where you're seeing these larger compliance markets, you're not going to get, it's going to be domestic, right? Offsets are going to be domestic for a lot of political reasons. I was working in the Obama administration in the State Department during the 2009 moment in time when the US actually considered putting a price on carbon. There was a bill going through Congress called Waxman-Markey. California, all of these large country domestic compliance markets are going to do offsets in their country, right, to benefit their own people. So back to the voluntary market.
Yes, it's a regulatory capture. Yeah, it makes sense.
Exactly.
It makes a lot of sense.
But one of the wonderful things about the VCM, right, is it allows some of this climate finance to go from the global north, which caused the climate problem, down to the global south, right, that will suffer from this problem. And so I think that's why the Paris Agreement crediting mechanism, Article 6, was at one time called the Sustainable Development Mechanism, in recognition that there is a climate equity issue here. And it's worth thinking about. So from the very start, we have always said we want to have our greenhouse gas integrity side by side with sustainable development impact ratings.
Cool. Thanks.
Certainly. And quantifying those environmental and social and biodiversity benefits are, very, very difficult to do. So kudos to Calyx on the environmental and social risk measurements. But yeah, touching on some more recent market news, I wanted to touch on the first week of August briefly, and then talk about some headlines that Calyx drew in the past few weeks. And so for the first week of August, we saw seasonal dip in voluntary credit prices and retirements, common summer slowdown, but this year's pace looks unlikely to match the first half of 2025. So retirements from the big four registries, Vera, Gold Standard, ACR Car, hit 2.1 million between August 2nd and 9th, projecting under 9 million for the month, and prices fell across the board. But in the CDR market, the absence of Microsoft had left volumes quiet, and Calyx drew some headlines by giving Climeworks, their Orca DAC plant in Iceland, its lowest tier 3 rating, citing overcrediting risks. And this was something that Climeworks had said came without consultation. So I would love to talk about that for a second, and kind of hear your insights about the rating on the Climeworks DAC plants and how the market should interpret such a rating. Yeah.
Duncan, do you want to talk about the market generally? And I'm happy to take the Climeworks question.
Our job is to be evidence-led, and I'm sure Donna will say a thing or two about why the evidence pointed us in this direction. But we often get questions, and I'll just bring it down to a micro level before going back to the macro. We often get questions from customers saying, "Well, but you're tough on this, or you gave that a bad rating, or this, that, and the other." And I have to say this carefully, but our job is not to make people happy with ratings. Yeah, the ratings outcome shouldn't be what makes people happy. What should make people happy is that we're very thoroughly evidence-led, that we have done deep research and homework on how to assess and apply that meticulously, rigorously, and always in the same way across project types, across projects. And that's our job. That's what we want to make people happy with. And sometimes people are going to be surprised with ratings, and sometimes they'll be really happy because, hey, my project got a AAA. And sometimes people go like, oh, hang on, how come I'm in tier 3? So what does it mean for the market? It just means what it says on the tin. There are risks associated. Yeah, the greenhouse gas rating is, after all, a risk rating of, what is the risk that the claim of this representing 1 ton of CO2 not holding true? And in this case, the outcome of our research pointed in that tier 3 direction. Then we can, so what does that mean for the market? Yeah, it means for the market that, hey, the heuristic of all removals are good and reductions are bad, that heuristic doesn't hold. And just like this was our first public DAC rating, our first biochar rating ever was also a tier 3. But we've got tier 1 biochar, just like we have tier 2 biochar. So I think that's the other thing for the market, and saying, hey, you can't rely on those heuristics. But maybe we can double click a little bit on this particular rating.
Yeah, maybe to your first comment, and asking us to comment sort of on the slowdown. I mean, I just think the summer is slow.
Yeah.
And it's not a time when people are buying, transacting, trading. I don't know how the
Interestingly, and
Europeans do it,
I
but
can
they
give you
have like
some
these long
anecdotes.
vacations. So,
Yeah,
sorry.
no, totally. The European market is always closed in August. I think it's a dreadful kind of data point to take around the health of the market, to be honest. But like anecdotally, like we saw in the run up to now this August break, that there's a lot of action from corporates, certainly around RFPs. So those take time to ultimately be reflected on the tape, let's just say, because they have typically 90-day payment terms. So they might select and then structure the portfolio, right, and then execute the deals. But then delivery only occurs 90 days later when payment then occurs. And so I think that there'll be a reflection in that Q sort of early Q4, late sort of Q3 timeline, right? The end of this month and September. So that's what I'd say there. But yeah, really keen to unpack this kind of view. And Donna, you kind of tease a little bit here, the report that you've been working on. I'd love to kind of learn more about that, and specifically as how it relates to the DAC decision around the ratings.
Yeah, maybe this gets back to what we first talked about early in the session around how do we rate and has that changed? And it hasn't, because at the end of the day, at least we're talking now about the greenhouse gas integrity rating, it is what has the atmosphere seen and what is the claim of the credit, right? So every credit ostensibly is 1 ton of climate benefit, whether in avoidance or removal. And the issue, and this is not just with this one project, so I don't want to talk particularly about this one particular project, but around the direct air capture methodologies allow a kind of accounting that I think anyone looking really carefully at that methodology would say, yeah, like in the early years, the credits that are sold are not going to be the same as the atmospheric benefit, because that is baked into the accounting. And this paper that we've written together with Meta explains this in quite a bit of detail. So maybe that's something that we can share after the session with your audience. But that's all it comes down to. And that is how the same principle that we have applied across all the credits that we have rated. So it hasn't changed. As Duncan said, we really try to be very science-based. I will say, though, to Climeworks and other DAC projects credit, over time, as long as they continue operations, the claim begins to match what the atmosphere sees. So as long as the DAC facility remains in operation, over time, our ratings may change along with that. So, but it all comes down to that same principle, like what is the claim of the ton and what has the atmosphere seen, and do those match?
Can you talk a little bit about the report that you mentioned with Meta?
Yeah, so we wrote a white paper about the challenges around this issue. It has to do with what's called embodied emissions. So in other words, many of these facilities, there are a fair amount of emissions that go into building the facility. Steel, cement, and those are an emission, right? So when you look at the early years of a project, what has the atmosphere seen? It has seen a large source of emissions and a little bit of a removal. And the way that the accounting works is to kind of amortize those emissions. So this is baked into the methodology. The methodology allows this kind of amortization of those emissions, which means you're selling a ton of atmospheric benefit in the first year, maybe, but actually the atmosphere has seen a net emission. So, but I will say, okay, 2 things I want to say positively about these projects. As I said, over time, we believe that ratings will change and improve. So that's important to know. And second, like we need these technologies. We absolutely, by mid-century, will need to be sucking CO2 out of the atmosphere. I wish it wasn't the case. Over, like I said, the decades I've watched climate policy, it just is moving way too slowly. So for those of us in the space, so frustrating. We absolutely need these technologies. I am glad that Climeworks exists, as well as all those other folks who work on engineered carbon dioxide removal, because we absolutely need this. But for the confidence of the market, I think it's important that we retain some of these principles.
Yeah. That's really interesting, and obviously it's a sober assessment, and one that's just very, very mathematical, right? In terms of that assessment, talking about those embodied emissions. I think there's a parallel, right? Like I can think of 2. I can think of, you know, embodied emissions associated with the construction and kind of the deployment of wind, like at scale, right? These wind turbines are enormous installations, and they have a pretty big sort of embodied emissions at the beginning. Same with EVs, right? So with cars, getting them set up, like there's an embodied emissions component, but it's that lifetime component and the transition that is then as a result of that towards cleaner consumption of energy. Do you think that they're up?
Yeah, I mean,
to the
it's interesting.
metaphors?
I think the difference with some of these engineered removal technologies, it's just the ratio, right? So if you look at a wind or solar or large scale renewable energy, the amount of renewable energy and reduction in fossil fuels is really big compared to the
Yeah, the
embodied
payback shorter.
emissions. And that's why in some ways, even if you were to kind of not account for those embodied emissions, you're not going to get the same kind of problems with overcrediting that
Yeah.
you get with a direct air capture facility.
But to qualify, like it's not an indictment on the methodology or the individual companies that are developing these projects. Like you said, they're incredibly necessary, and we need them to scale, so that they need to essentially be given the latitude to effectively operate, right? Like you said, if they can continue to persist and have that longevity, then over time, presumably, depending on efficiencies of scale, they can sequester more than what they emitted in getting it set up.
Yeah, that's true, Nate. But I will say, just being a long time carbon market watcher, every time someone says, "Oh, we had to like do this in the methodology to make the financing work," is where we end up in these problems, this crisis of confidence that we're in, right? Like, oh, we're gonna like give up, we're gonna like compromise on the carbon accounting in order to make the financing work. That's exactly why I think we are in this place where we all want confidence in the market, right? We all want the market um, to do
But
something
these new
positive.
technologies are really at the frontier, right? Like they're very expensive to finance and to stand up. Hence the kind of the premiums that they're trying to attract in the market. And the buyers of these credits tend to be more catalytic investors, right? Like they're trying to get over the hump from a technology curve perspective, right?
Yeah.
Typically a role that's played by governments, but in this case, private sector stepping up to do that. How do you see that? Because it's a bit of a paradigm, right? Like it's a
Yeah.
bit tricky.
And I think it's fantastic. Like, I think that the companies that are willing to pay $500, $600, $1,000 a ton in order to get these technologies off the ground, it is fantastic. And I will say most of them that I talk to, they don't really even see these as offsets, right? They see it as an investment in the future. And that's the key.
Yeah, I mean that's what the whole purpose of the market is for, right? It's to be a catalyst for these projects and to make the uneconomically viable economically viable at the end of the day. Um, but I think shifting gears towards a more macroeconomic view, I wanted to look at some data from the recent Science-Based Targets Initiative trend tracker for August. And because the headlines often focus on challenges and in climate policy and in markets, but corporate climate action has been quietly accelerating at quite a record pace. Right. So now there are 1,000 companies that have science-based targets covering over 40% of the world's market cap. And the growth in these net zero commitments has been extraordinary, right? Like it's
You say
triple
1,000 or 11,000?
11,000. 11,000.
Okay.
Yeah. And the growth of those commitments has tripled in just 18 months. And Asia, in particular, has become a real engine for this movement, with countries like China and Thailand, Japan, driving the target setting, not just for their operations, but across the global value chains, the global supply chains. So, double tapping on this, I wanted to, you know, hear your perspectives on what you think is driving the acceleration in both near-term and net zero target adoption, and what kind of forces are at play in when we see talk about the corporate landscape with regards to climate action and correlating it to the voluntary markets, because there's a common debate between stakeholders on this, right? Some say that SBTI is doing too much, confusing the corporates. Some say they're doing too little, they're holding back the market. So I would love to hear your thoughts on this.
Maybe I'll start with this one, Eddie, because yes, SBTI adherence has grown, and I think it's a reflection of a number of things. Number one is companies realize that whatever political winds, whichever direction those push in, the reality of climate change is here, and it's going to impact business, and no business can afford not to get involved, not to start thinking about it. At the same time, SBTI, I think, has, in the landscape of standards around this, has established its brand as one of the leading ones, and so I think people tend to gravitate towards those labels that are the most commonly accepted, and I think that also helps their growth. A couple of things I'll say though is we as society, including the corporate world, need to make sure we get the balance right between target setting and action taking. Yeah, and so there is a bit of that disconnect between saying, "Hey, I set this ambitious target and it's out there, and in the meantime, am I on track or not?" And I'd say in parallel, almost commensurate to the growth in the number of companies that have signed up, we see a growth in the amount of backlog. Yeah, there are gigatons of backlog versus target versus SBTI targets. And I think that's something that we need to be concerned about and make sure we don't lose sight of the importance of action now. And with climate change, it's always action today that is worth a lot more than action later, because it's how much is in that bathtub that matters. And so that's something that I'm a bit concerned about. Is, are we focused enough on recognizing companies that take action today, even imperfect action? Are we recognizing that enough? And are we pragmatic enough? And pragmatic doesn't mean at the expense of integrity, but are we pragmatic enough in terms of the tools we're willing for companies to use to take that action today? And I'd say we're not pragmatic enough. But those are kind of my 2 cents on this.
Yeah, thanks for that. Donna, do you have any?
Donna, I'd love to hear your insights.
You're on mute.
Yeah, no, I very much agree with what Duncan has said. On one hand, I'm quite encouraged by the number of companies that are stepping up and taking targets, especially voluntarily, like in this policy vacuum. I worked.
But I think it's actually a reflection, right? Because we saw a prelude of this, right, during the first Trump administration. When there is a policy vacuum, that private sector tends to fill that vacuum, because I think they like having clarity and just budgets and forecasts for longer decision making, right?
Yeah.
They don't like the instability and the volatility.
I feel like it's a little bit different, and this is Trump 2 is different than Trump 1.
I agree.
It feels different. I just remember in Trump 1, maybe partly because I have been sort of in the government policy space, there was this backlash. Like, do you remember the "We Are Still In" movement? Where you had corporate leaders stand up? They all showed up at the COP in full force to back the U.S. delegation, to say, like, don't worry, we as U.S. business leaders are still in. I don't see that.
Well, that's because
I actually
we also
wrote an
had
article hoping for it, but unfortunately, I don't see, because there's almost like a retribution in the U.S. that's happening now. So it's really
it's because of
unfortunate.
that. It's because of that retribution. Essentially, the Republican Party in the United States essentially started targeting the investor base, right? The BlackRocks of the world, that were putting a lot of that pressure to create that kind of sandwich from civil society and then the investor base, and help, basically putting pressure on boards to make these pledges and to sustain them, and ultimately, having a kind of divestment movement. But effectively, that's shifted with this administration. I get it, but I take this kind of coming back to salient sort of data-driven insights. Like this SBTI report, I think, is really a positive outcome. It shows that momentum hasn't stalled. In fact, it's actually increasing with the number of companies that have either said or committed to science-based targets. It's not just like headline growth, like they're actually, increase in that validated near-term targets. And it's a pretty significant surge. So I think we've got to take some solace in that view, despite the kind of sound bites and the everyday kind of conversations that we're having.
I
To
totally
Duncan's
agree.
point, it's going to have to be
yeah.
like the conversion. Like, how many of these companies are actually going to reduce their emissions in line with these commitments, and they're going to stick with them? And then ultimately, what is the role for environmental attribute certificates like carbon credits in helping them to achieve their short-term targets? And then how do we get to that carbon removal for, you know, the delta, the unavoidable emissions?
Yeah. No, I agree. I think companies are marching forward. Most of the ones that I talk to is no change, still marching forward, maybe just a little bit more quietly, right? Like
they're just more quiet. Yeah, that's what
just
it
a
is.
little more
They're not
quietly.
singing it from the rooftops. Yeah.
Yeah. And I think that's a great thing. I do think one trend that I see, and I'm curious what all of you think, um because I'm not sure it's a good thing, which is a lot more focus on insetting rather than offsetting. And it's not because I think insetting is bad. I think it's a really fantastic thing. But the whole idea of the market was we can do more by trying to find the lowest cost abatement today. And if you're only focused on insetting, then we're not availing ourselves of what the market was supposed to be, right? Which is like doing more by finding those low hanging fruit. So,
and doing it at the lowest possible cost. Yeah, it's actually a much
yeah.
heavier bag to carry, the insetting piece. But I think it comes down to, you talked about, you know, companies being super protective of their brand. And I think it's a much more resonant story to discuss with internal stakeholders, how you're helping that supply chain to decarbonize and you're investing the money there. It helps to build longer term relationships. We had a guest talk about that, you know, a couple of months back, and you know, coming from a corporate and talking about those kind of relationship building pieces, and then seeing the material decreases. Like he said, from a reduction perspective, effectively, it makes a lot of sense. We get a lot of ROI from that kind of investment. It doesn't translate necessarily, because the atmosphere is one piece, right? And if you can, and the whole beauty of the market is, like you said, this north-south divide, you can actually do it at a lower possible cost. It's a low hanging fruit. Why wouldn't you do that? That's the rational economic actor. But I don't think that, given the lack of incentives and recognition, to Duncan's earlier point, that necessarily is the key. Yeah. So, yeah.
But I think on insetting, businesses want to invest in things that they understand, and I think it's an easier sell internally to you know, treasury teams or the you know, CFO per se, for the sustainability officers, right? I think it creates this kind of operational resilience mindset where you know, insetting projects like regenerative agriculture or agroforestry or renewable energy installations can improve their productivity and reduce input costs, and it, you know, raise their triple bottom line. At the end of the day, I think that's what they're focused on. And so sometimes, you know, when some, you know, CFO is proposed with investing in a project that's completely uncorrelated to their line of business, I think it just doesn't make as much sense to them as in investing in a you know, carbon removal or reduction project that falls directly within their value chains, right? Because that's technically, you know, an investment in their bottom line and in the industry, right? And it's, I think, an easier sell internally, and it's more probably interesting to them too.
Yeah, I wish it just was a both and, right? Not a let's just focus only on because I don't know, at the end of the day, I can see how it benefits the company in lots of different ways through relationships, et cetera. But I don't know, on a planetary basis,
No.
I think it should be
Yeah,
a
you need
both
to have
and.
and. Yeah.
Yeah, you have to.
Yeah,
Completely agree.
and one more thing, Eddie, I think what you're saying is totally true, and I think it's something we've seen in the last couple of years, that companies have been wanting to try and get the offsetting, insetting action closer to their business. And so I see more industrial companies looking at industrial credits, and ag and FMCG companies perhaps looking at nature, et cetera. So yes to that, totally understand, and I think as the market recovers, there'll be greater variety rather than less of different credit types. The other thing to watch is, obviously, the voluntary market has been learning some pretty expensive lessons in terms of what works and what doesn't with different methodologies, and how to make sure that you produce high integrity credits. And so the same thing is valid for insetting. Yeah, insetting also follows a certain methodology. Sometimes companies just spend a lot of rigor in building those methodologies, but we have to make sure that we're not trading the lessons learned from the verified market or the voluntary market, whatever you want to call it, and lose them and say, hey, well, we're just gonna put our, use the wet finger method for insetting. And so I think there is learning to be had there. And it is something that we're hoping to help companies with, as if they choose insetting, how can we use our tools to help you make sure that the methodologies you use internally, measure up.
Yeah. Yeah, and I forgot to mention just the fact about scope 3 there with insetting, right? Like they want to directly correlates to their scope 3, which is the largest source of emissions for a lot of these large corporates. So just wanted to double tap on that. But I think this is a great transition to wrap up. And I think I want to end off on more of a forward-looking perspective, right? So one last question. I think, looking 5 years into the future, what's one prediction or, forecast that you have for the voluntary carbon market, right? Or what are you most optimistic about? You can kind of take that question how you want it. It's not a trick question, but give you a second to think about it. Or if,
Look,
Who wants to jump in? Let's not all jump in at once.
I'm fundamentally upbeat about carbon markets. I've been on the other side, on the corporate side. I know how operationally complex and expensive some of the other levers of action are. I think companies are using those levers, but are realizing, hey, it takes time to do it right. It needs to be economic. I need to be able to defend the ROI of every investment decision I make. And carbon markets just have a role to play in addition to that, next to that. And if we can continue with the current move towards higher evidence-based or higher evidence of integrity, then I think a lot of companies sitting on the sidelines are going to join. And also the dearth of other levers is going to bring policymakers back into the fray and saying, hey, maybe there is room where earlier it was deemed not pure enough. I think people are going to make more pragmatic decisions. So I'm a bull on fundamentals, but not necessarily bull on how fast things will turn around. I don't expect a flash in the pan. I expect gradual strengthening as the evidence supports strengthening. The other thing, perhaps at a much more operational level, I expect a much more digital and digitized carbon market. I think by 2030, if that's your horizon, I think a lot of the evidence and documents, etc., will be digitized, but that's probably a secondary prediction.
Yeah, and all that digitization and AI is going to make our emissions go up. I think for myself, I just don't know how we get to a safe planet without putting a price on carbon. It is looking across the world, like where have countries been able to like really, or states like California, been able to reduce their emissions. Putting a price on carbon is a great tool. And I just think we have to do that. So I don't know if I'm bullish. I agree with Duncan. Like, I don't know if I'm bullish in the way like it's going to be a hockey stick by 2030. I'm more feeling that we absolutely need this march towards reducing our emissions, and this is like one of the best tools in the box. And whether it's voluntary compliance, carbon tax, like there's lots of different ways to bring in this externality, right, internal into an economic system. And that's the best way to optimize on the activities at in a cost-effective way. So in that regard, maybe it's just as much a hope as it is a prediction that we need to employ so many different tools. I'm not saying this is the only one. This is not the magic bullet. I don't believe it's the magic bullet, but I feel like it's a really important one in our toolbox that we just really should avail ourselves of. Just being a longtime climate watcher, yeah, I really hope that we see the maturity in the markets that allow them to strengthen over time. And I do feel, maybe one last thing, I do feel like we are starting to see the edges of that, right? Infrastructure being built. I love that insurance has come forward. I think that's great. I think different types of intermediaries, I think ratings agencies are part of that infrastructure, digital MRV, like there's so much being built. And I hope that helps to strengthen market.
Say one more. I like what you said, Donna. I think in 2030, everybody working in carbon will start their day with today in carbon. You guys will have evolved from this week in carbon to today in carbon.
I don't
Twig
know.
to
We have a business to
start of
run.
the
This
day.
is just fun.
Yeah.
I don't know. I
I
don't know
don't
about becoming a
think
full-time
that's
journalist or a podcaster. But can I take a stab at this? And I love those insights. So thank you, Duncan and Donna. They're really resonant with me. I want to answer Eddie's question by kind of a bit of a look back, like, and just kind of wrapping up something that you said earlier, right, in the conversation for the both of you. And so if we go look back, 2020, I think was the year of carbon project heuristics. It was an interesting time in the market, and we saw that growth in 2020, 21, and 22. But we've seen this kind of reckoning and correction in the market that's been well documented and heavily sort of litigated. And I think that 25 is now this year of integrity and intelligence. So the market isn't just asking what it's buying, but finally asking like what it's worth it effectively. And you highlighted like the infrastructure that's been built in this time, and technology is playing a key role. The insights and the risk lens that ratings provides is playing a key like roles, ICVCM, VCMI, et cetera. And the market is essentially shifting from this trust us to show us. You guys talked about that, you know, if it was VCS or it was gold standard and correlated standard, that was enough. And now we're moving to sort of decision-making built on data and accountability. If we look to 2030, I just think that it's a really important time, and it's a year of climate consequence effectively. And I think that carbon markets just represent such a key and important tool. Like I think we recognize by then this kind of paradox, and we make peace with it, that the market is imperfect and that there are trade-offs and tensions, but there's going to be more granularity, more clarity, and that this is a really important tool, and it remains such a powerful tool that in order for us to basically address the climate crisis. And so we just have to be willing to wield it with integrity is essentially the summary. And then to Donna's final point, like there's going to be this convergence between the traditional voluntary markets and various different flavors of compliance. And I think that those are the drivers that hopefully then push this big SBTI kind of growth in terms of reporting and convert them into action. So I'm again, I wouldn't say that I'm bullish. I'm with you, Donna. I think I'm very hopeful that the market really grows up in 5 years' time.
Yeah, and maybe can I say as part of that maturity, I think what it also requires of everyone is not to expect perfection. And I think we always ask the wrong question. We ask the question, is this credit perfect? Not, is the market delivering more planetary benefit than if it wasn't there? And I think that's a problem just in the community. And maybe people think we're tough and we rate tough, but I think what we're trying to do is just drive people up that impact continuum, right? Like we don't set a particular, like you have to buy like X-rated project. We don't say that. We're just like, we just need to see, we just want to drive more impact, not perfection. And I think that the community needs to wrap their heads around that. Like, are we getting more mitigation with this market or less? And if it's more, it doesn't need to be perfect, right? We just need to keep improving.
Yeah. So can I try to summarize that? Effectively, maturity means essentially moving from like buying the credits, like and you know, talked about this 1 ton doesn't equal 1 ton effectively, but now buying with conviction because of a better data-driven sort of insights, and it's not just sort of tons on the ledger, but proof of the impact, effectively trusting the process and kind of, you know, moving in that direction. Do you think that's an act and a view? around maturity?
Sorry, I didn't actually hear what you said, Renee.
Oh, I'm not sure if you did you lose my mic?
No, I think I just had a hard
Okay.
time. Yeah.
Yeah,
If you
no,
can
that's
just
okay. So
repeat
just
that.
well, I guess I'm just wondering, you know, how do we best summarize this kind of transition towards maturity, right? How would you qualify it?
In the silence, I'll have a stab at it, and then
Go
Donna,
for
I
it.
think the question was for you, but give you more time to think. To me, it's two things. One is, as you said yourself, we're moving to a world of evidence. Trust me, show me, and I think that's an ongoing process. The other one, I think, what I interpreted Donna is pointing towards is saying, well, what we need to see is over time, a gradual being able to account for, yeah, we did more and better this year than we did last year. And next year we're going to do better again. And next year we're going to do better again. This continuing march upwards in terms of the amount of impact and the quality of impact. That's where I'd like us to be going.
Kind of like the Kaizen philosophy of continuous improvement and ownership.
Yeah, I think that's got a lot to go. Yeah.
Cool. Yeah, there's a lot of work to be done, clearly. But I
Yeah.
think we could talk for ages. I'm conscious of time. Last words for folks? Any last words,
Onwards.
Donna? Duncan? Onwards? Donna? You have the last word.
What's the last word?
Yeah.
I think part of the maturity of the market is education, just of everyone around the market. I think one thing we talked about was, maybe this was even before the call started, like these internecine wars that occur. And also folks who just maybe are expecting perfection. I mean, there's lots of, I think, education that can usefully happen, and I think your podcast is a big part of that. So maybe my last words are just thank you so much for working towards this end, which I think is really important, because it's not just, it's all these improvements, right? It's infrastructure, it's MRV, it's digital, it's evidence, it's all that, but it's also like a broader understanding by the entire community around, yes, we are marching towards something positive. And I think that your podcast helps to do that. So that's my final word. Thank you so much.
Yeah,
Thanks for joining us.
thank you for the kind words. And this has been a really, really fantastic deep dive into numerous topics. So thank you guys for sharing your expertise and your insights. It's been a pleasure. And thank you to our audience for tuning in to This Week in Carbon. And we'll catch you next week.
Thanks, guys. Really appreciate it.